Can you explain why we need an ETF to do this? I mean, one of the points people bring up to me all the time when I talk about these inflows is, well, I can go buy Treasury Direct, I can buy government bonds online directly. What do you get when you get an ETF? Is that a structure that's desirable to own short maturity treasuries?
Sure, so we think so. It's also why we're launching 6 more to help people do this. But at root, what you get is the bond that you expect to get. But I encourage others who want to buy it on Treasury Direct or who want to buy it through the brokerage firm simply to try it. It's hard. There's no ticker. You need an 8-digit QSIP. I hear Dave's laughing because I made this pitch to him 6 months ago, and I think he had the same response, but I'll be curious to hear if he's changed his thinking.
Well, the obvious point here, to fill in your thought process, ETFs trade intraday, too, as well. And there's an advantage of it, and it is confusing. Dave, I wonder if you agree with this. I actually did this. I went on a big brokerage site and tried to buy the 2-year a little while ago, and it is confusing. There's 24 different QSIPs, I think, just for the 2 years.
You can do it.
It's every month.
It's not impossible. It's just
no, but it is
complicated.
Confusing.
It's confusing. If you go right now to your Schwab or your Fido account and you say, I want to buy the 2-year, they'll quote you a maximum yield to maturity right now of something hovering around 5%. When you go to click buy, what you're going to see is a dozen QSIPs. And those are going to be everything from the last on the run zero that they published last month to some piece of paper that was a 15-year note a long time ago and is now expiring, in that window that is a 2-year treasury. So they all end up getting repriced the same. So from a notional perspective, you're going to end up pretty much in the same bucket. But it's not the case that you can just simply click a button, get the exposure of the headline rate that you're reading in the Wall Street Journal or seeing on CNBC. It doesn't work that way. It is much more complicated. And if you're an advisor, you're actually probably paying more than an individual investor for the privilege of doing that. And heaven forbid you want to do something like rebalance on the 15th of the month. Now you got a whole nother world of pain.
So, but I want to get back to the point. Do you agree with the idea? Can you make a case why we need an ETF structure? Like, why do we need a 2-year ETF
because the bond market
going to?
Yeah, because the bond market is effectively a by appointment market to start with. In this case, you can make that appointment with Treasury Direct, right? You can go directly to the source and maintain a separate account over at Treasury Direct, which is probably where you've got your inflation bonds and those things too. It is a terrible process that is rife with opportunity for user error and miscommunication. It's very gross in the sense that you're working with large chunks. You're not being able to do precise rebalances or precise allocations of individual dollar amounts. You're at least buying $250 blocks, if not 1,000 or more. All of those things make it just frankly inconvenient and often more expensive than just buying a 15, 20 basis point ETF that's going to do it for you.
Well, there's a good point. Alex, you charge 15 basis points.
15 basis
right?
points.
And can you make an argument, Dave, as an impartial observer, that it might be worth it to pay those 15 basis points?
I would go so far as to say that while I am not personally invested in either of these funds or directly in bonds, if I was trying to get an allocation for the 2-year, I would not be going to Treasury Direct. I'd be looking at a product like this or at competitors that are starting to come out offering similar kinds of exposure. But if you're an advisor, again, it may actually be monetarily cheaper to get your exposure this way than to be trying to manage the individual costs of your platform.
Now, I'm trying to think of play devil's advocate here. Isn't the issue, if I were to buy your 2-year ETF, I'm getting it on the run. So right now, this month, it might be 4.8%, but you're buying on the run. So the yield will change depending upon the demand, right? So a year from now, I might not still be collecting a 4.8% coupon. I might have a different coupon. Whereas if I bought it directly, I'd be still having that 4.8%, right? Or roughly that.
That's right. So the on-the-run nature will force us to rebalance every month, which is good because we stay liquid, but has the downside of you get the current reset rate. But when rates do reset and, say, go down, the price of the bond will go up, so your holding and the amount of bonds we can buy for you will go up. So you'll still have some total return impact of doing this versus buying and holding a bond.
Yeah, that's a good point. You're about to launch some new ones, right? You have 6 new single bond ETFs. Tell us about that.
Yeah, so similar to the ones we have today, which look after the 3-month, the 1-year, the 2-year, and the 10-year, we're going to fill out the rest of the yield curve. So you'll see the 6-month, the 3-year, the 5-year, the 7-year, the 20-year, and the 30-year come out. And it's really been just an answer to market demand. Folks have asked us to give them a full rates tool set, so when the yield curve shifts, they can shift along with it. And we're going to give the people what they've asked for.
Dave, does this story have legs? I mean, the problem with bonds is they don't sort of have the narrative power of equities necessarily. We have stories behind equities and, you know, personalities. Bonds don't have that kind of narrative power. But does this story have legs? I mean, for example, people have called and asked me about preferred bonds. Ford's paying, I don't know, 6.5% for their preferred bonds. That's been a terrible performer this year. I don't know I'm trying to figure out what the right narrative is to construct around the bond story.
I think the narrative is I really would come back to the issue of diversification, right? The reason that you own something more than a single ticker in your portfolio is because you don't want that exposure to single issue blow up risk, whether that's a treasury bond that gets repriced because we have a 1% surprise increase, whether that's the global economy tanking or whether that's an earnings recession. You don't want to have all your eggs in one basket. So bonds have always traditionally been that zagging diversifier when equities zig. I would actually say this is a fantastic opportunity for folks not just to assess their stock bond ratio, but consider the role of other counter-correlated assets they may have, whether that's the equity in their home or a managed futures product.
I would agree with that. Would you, Alex? I mean, he just made a simple point. Diversification is key. So you want to have a diversified group of assets, real estate, stocks, bonds, commodities. I collect rock posters. I always say to my wife, she says, "You bought another stupid rock poster?" I said, "It's not a stupid rock poster. It's a diversified asset." And I get away with a lot with that. With that line, I get away with a lot. Honey, it's not a stupid Jimi Hendrix poster. It's a diversified asset.
That's right.
Actually, I show her that as part of the portfolio.
That's smart.
And she says, "Oh, yeah, that's because you're talking to Dave too much."
I don't think you can get that into an IRA, though. That may be a problem.
I'm working on a separate, a classic rock portfolio ETF.
But I think the answer is yes. I mean, look, we do this for a living. We trade bonds, but we own other assets as well, and we encourage everyone to seek financial advice because what's right for one person isn't right for everyone else.
Yeah, good advice. And this has been a fascinating conversation, folks. Remember, when your mother asks about a 2-year bond, there's something going on here. That does it for this week's ETF Edge. My thanks to Alex and Dave. We've asked Dave to stick around for the ETF Edge podcast right after the show and give us his broad perspective on where ETFs are going this year. And remember, you can see all of our shows. It's on the website, folks, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.